Hi, I'm Renate Klapping, and my question is to Michael. This sounds really interesting. You had mentioned that from a satellite, the data you get from a satellite allows you to predict where there will be shortages of ground cover. How far ahead do you know? I mean, if people get a payout, will they be able to buy fodder for the animals so they save the animals? Or is the purpose of the insurance to replace it? The first one, I would think, would be much more attractive.
Yeah, shall I go ahead?
Yes, please. Go ahead.
So very good question, and we've been working on designing this for about 1.5 years, and we had for a while an asset replacement insurance, which is you let the animal die, and then there's also an asset protection insurance. You can actually predict, I mean, the way the actual insurance and information works, we know with some statistical confidence that deaths will occur about 3 months before they occur. And we were extremely motivated to do what you said. Isn't it a lot cheaper to keep an animal alive than replace it? And we actually were looking into, there's sort of compressed cottonseed cake fodder for animals, and you just mix it with a little bit of something and it keeps animals alive. Seemed like a great idea. We actually, we sort of decided that that was more than we could chew, because to sort of responsibly implement that, not only would we have to have designed an insurance contract to deliver the cash to buy the fodder, we'd have to be able to get the fodder delivered. Now, in a better, supply creates its own demand and vice versa, right? But we weren't quite confident that that would be quick enough to save animals. So for the moment, we've actually moved for what we think is the more expensive option, which is, it's being priced to replace animals who die. But the technology, because again, in Kenya, and I'm sure this is true other places, the rains fall in cycles. And so if you've gone through the rainy season and it wasn't a very good rainy season, the state of the range at the end of the rainy season is a very powerful predictor of what's going to happen in the next 3-4 months. And again, that's not surprising. But again, we have, at least for the moment, given up on what's the more intelligent option, or what it would appear to be.
Yes.
Thank you, all of you, for very interesting presentations. All of you basically alluded to the fact that it's important for people to understand these insurance products, and I guess that's part of the outreach. And I was wondering, from Michael in particular, for their current project, how exactly this was done. So these people that are overwhelmingly demanding these products, how exactly were they explained the insurance products? Particularly because I know, based on your previous work and also the work that Ruth and I have done on using experimental games, for example, to explain these, we find those to be a very useful way of trying to explain insurance contracts to people. And should that perhaps be an avenue to be pushed more, to basically explain insurance contracts to the people who are ultimately going to explain it to the end user, and then also to the end user? Is that perhaps a feasible way to push in terms of explaining these things?
Did you want to say something?
I do, but
I'll go first. Okay. Yeah. So in northern Kenya, in the film we saw, the video, the clip there, I mean, we are using a simulation game. So when the man was saying the green chip is a cow and the red chip is a goat, or Teodaj, you're still here. Teodaj taught me there's a third type of animal called a shoat, S-H-O-A-T, which is either a sheep or a goat. And if you're an economist, it's all the same. So what does it matter? I tell my food friends that, and they're kind of horrified, not to mention the animal science people. Anyway, so that game actually we worked on a long time, and it actually works really, really well. I mean, those of you that are not familiar with this kind of approach, the idea, the nice thing about a game like that is people can live in the course of a few hours, can relive their lives several times over, sort of with and without insurance, and they begin to see how the contract works. And the games have, in our case, basis risk involved in them, so they understand it doesn't cover everything and what it does cover. And in the games, we actually try to capture these nonlinear dynamics in a simple kind of way. We think those work very effectively. We also know they're very expensive to implement. And what we're doing right now with the games, we're using them partly as an educational mechanism, but we can't afford to do it everywhere. So we're using it as part of our research design. So we've randomly selected places. We play the game on the hypothesis that the insurance will be better understood and more likely taken up in those kinds of areas. I think we've talked about this a lot with a number of people. There's sort of two directions to go to really scaling it up, short of playing games with everybody that's a potential client. So one is, Len and I think at one point were talking about sort of the, what do we call it, the Avon lady approach? Sort of, idea leaders, not the Avon lady. But if communities and if communities sort of self-selected an individual who's their idea leader, the person they look to for advice or whatever, if those idea leaders are sort of collected together and play the game, right, in a sort of location within a district, say, then they can go back out with some other materials, and that maybe that can be a way to sort of take advantage of the understanding, but not have to retail it to everyone. I guess the other thing that some people react to when we talk about these things is that maybe this insurance doesn't have to be at the retail level. I mean, I think in some cases it does. In other cases, it could be imagined as portfolio insurance. And then you only depend on whoever runs the portfolio, the MFI, CEO or something, to understand the insurance. So anyway, that's what we've been doing. We think those kind of games are very powerful learning tools, but we also feel like there's a limitation to how far we can spread those out.
I do add something to that. Those were the two things I wanted to cover: is the cost effectiveness, and then this idea of the portfolio insurance. So don't kind of avoid having to explain them at the lower level. The downside of that, and I think we need to pay attention to this, is that if you remember, part of what we're doing with these insurance products is we're trying to crowd in this kind of behavioral change, so positive risk taking, and that if people don't understand these products and so if you stay at that portfolio level and they either don't know that it's even there, or even if they know it's there but they don't quite understand how it works, then you don't necessarily get those behavior change benefits, right? You don't get added investment or positive risk taking, and so we have to be careful.
So, Ruth, you have been also trying to do this in Ethiopia, so if you can tell us a little bit.
And I think, what I want to add is, the games, like Michael mentioned, are very useful in allowing people to sort of really understand some of the concepts that are harder to explain first off, like basis risk and things like that. But interestingly, we, in piloting these weather securities that I mentioned, we tried two different approaches. First of all, we tried just bringing in individuals and offering these securities, training individuals on these securities and offering the securities to individuals. And secondly, we tried sort of this more portfolio approach, and we brought in local leaders of local insurance, funeral insurance groups actually, and explained the product to these leaders, and then had them, we just let them do whatever they want to do. But it turned out what they did is they then went and held meetings. They explained the product to the members in their meetings and discussed it quite extensively. And the interesting thing is we then went back and did a survey a few months later to find out what the levels of understanding were. And the people who had found out about the product in these discussions with these leaders actually understood it better than individuals who directly attended training sessions themselves. So this idea of working through local leaders actually really does have bite to it, and probably partly just because it does allow this further discussion time that's built into to training in that way.
Yes, a question in the back.
Hi, Yurbal Yashlikov, IFPRI, MTID. I have a question, I think, to all of you. Do you think, in case of Kenya, this kind of risk insurance packages, in case of arid animal herders, will they induce any positive risk activities? Because, I come from my background that in Uzbekistan we also have a lot of arid livestock, and we have one drought in 3 years. So what farmers do, they try to catch a good year, produce a lot of animals, don't kill them, and then just kill them later in the summer, get cash, buy something asset, valuable, and when the bad year comes, they just sell it. But that doesn't change the positive risk-inducing activities. They don't do year from year feeding animals. They just wait for a good year.
Who wants to answer?
Very interesting discussion, and we've something I'll mention it to just broaden out your question a little bit. That's been asked of us many times is, if this does induce farmers to invest more in animals, will it lead to overstocking, and is that going to be a problem? And so, actually, we think the answer to that is no. I'll talk about that more if someone wants to puzzle it. But part of our answer on that has been it's actually not clear how farmers will manage it. So in your case, I mean, you're describing a risk management strategy. And the question is kind of, what's the rate of return when they have the good year, they get some animals, they sell them at the end, and then they hold it in another asset, right, which isn't going to die with the next drought. So the question is, what's the opportunity cost of having done that form of self-insurance? I mean, so if they just bought, if they bought an asset whose value didn't appreciate very much, then, obviously there was, unlike investing in animals, they maybe gave up something. So one option would be people might take a few more chances. Maybe it wouldn't work in Uzbekistan. I don't know, obviously, that area. But so the hope would be that this might allow something. On the other hand, another way to think about it, and Renate, back to your earlier question, one of the differences between sort of giving people insurance to buy feed versus giving them cash is it actually it allows them to hold on to the liquid wealth, and actually may if people invest a little bit more, a drought actually becomes almost like an occasion to cash out and maybe go into something else, which again we don't know, and that's the sort of thing we're going to have to do. Whereas if it was a feed thing, you're paying the insurance in cottonseed cakes. You're sort of locking them into that particular strategy, and maybe what you want to do is just preserve the asset value. Maybe let them, grow animals 2 out of 3 years, not just 1 out of 3 years. Then on average, and if they can do that with the help of insurance, then maybe they end up with more stuff, and then maybe they make a transition. Again, we don't really know, but there's a lot to learn yet on that.
Yes, please.
Hi, my name is Vishal Patel. I have a quick question about your eventual hope that you're going to expand or increase the number of insurers that actually offer this type of product, or at least assuming that it's a positive return that you get. Are you setting up an appropriate regulatory mechanism for this type of event when other entrants enter into offering an insurance product for farmers?
Well, we don't yet have the issue of a second provider of the insurance. I mean, the insurance contract has gone through the standard regulatory mechanisms within Kenya. At one point in time, we were actually trying to see if we could work with a consortium of insurance companies so that between them they could carry a little more risk and also get a little more competition into the market. And I know that's not exactly, but let me just say one more thing about that, because the other piece in this, there's reinsurance provided on this contract by Swiss Re, is actually who's providing the reinsurance. That is also not an especially competitive segment of the market. And an important partner in this program is actually a new IFC facility called the GIIF, or Global Index Insurance Facility. And their notion is that smart subsidies, that they recognize that the markets are new, they're small, they're uncertain, and not all that competitive. So when we tried to get reinsurance for this product, we knocked on a number of doors. All except for Swiss Re said, this is really interesting. We can't wait to sit back for 1 or 2 years and then decide if we want to enter this market. So then when Swiss Re gave us a price quote, which was different, I won't be critical because they were the only ones, but when they gave us a price quote different than we were hoping for, we didn't have any recourse. But I think you're suggesting in a happier future when there are more people, there's things to think about.
Just to follow up on that, what was the reaction from agencies like USAID or maybe OPIC or any of those types of maybe some NGO groups for providing reinsurance mechanisms as opposed to going to Swiss Re?
From our perspective, we actually tried to use our guarantee facility not in Kenya but in the Peru case when we were setting that up, and it actually turns out we can't use our guarantee facility for insurance purposes. So we're actually quite limited. I mean, we, in earlier years anyway, we didn't have the kind of resources to really be setting up, any kind of reinsurance or the indemnity funds necessary for these kinds of activities. But I think also in principle, we really believe that what we need to do is try to crowd in private sector participation. So, I mean, I can't speak for other donors in this case, but for USAID, it's not really an option to act as the reinsurer on this, even with expanded budgets. That's not how it'll be used.
Thank you. There is a question at the back. Yes, please.
My name is Marilyn Hoskins. In the late 70s, I had the opportunity of evaluating an NGO project in Niger. And I very much enjoyed hearing what you were doing in the arid areas. But in some of the non-arid areas, where looking at rainfall patterns and so forth is not the only issue. There was a project in which they gave loans to people to buy animals in a cattle fattening project. It was near an urban area with a market. The poor did not participate until they put in an insurance program. But the insurance program didn't run the risk of, if you had a cow that wasn't doing too well, you sort of let it die. It had a regimen with a veterinarian. So if your cattle was poor, you had to go to see what the advice was. And if you followed the advice and the cattle died, then they gave you money to replace the animal. And at that point, the poor participated very well. So I just thought it is important to think about the other things, like the agricultural agent who knows what kind of diseases are coming in, or the veterinarians who could help with the animals.
Monique Cohen, Microfinance
We hold 2
Opportunities.
minutes.
I've been listening. Thank you for a very interesting discussion. But one of the things I haven't heard is how much is the premium relative to income, and how do you pay it? But is this mandatory or voluntary insurance? Is it linked to a credit program? Is it linked to another program? How does the client interface?
So, both questions. I don't know, whoever.
Did you want to talk about the one you're doing first, and then I'll say a word? Yeah, so the premium rates to the people are about, they're roughly in the neighborhood of 5% of the insured value. Pardon? That's partially. It's 1.2 times the actuarially fair price, so it's a 20% markup. But it is subsidized to get it down to that level with the GIF. So it is a real question. We actually did a bunch of willingness to pay analysis ahead of time using several different methodologies. And there's 2 issues in there, sort of how much are you willing to pay, and then sort of your liquidity constraints in terms of being able to pay. And right now we're exploring those issues. I mean, we'll find out what people are able to pay, which is sort of a combination of their liquidity and their willingness. And we'll find out. Now, part of our research design, which is being done really for the purposes of research, but is also going to have an interesting side product, is we are, as researchers, providing discount coupons. So in other words, we will randomly distribute in certain places coupons that give people discounts that will bring the price way down for some people. The subsidies will be up to, I think, 90%. So it'll be almost free for some people. And we're distributing them within the sort of the vulnerable and poor population. So we're not trying to subsidize, we can't afford to subsidize the insurance purchases of larger scale producers. And what we're going to be able to do with that is get a sense of sort of what is the ability of people and the willingness of people to pay. And we think that's important for a fundamental kind of policy reason. I mean, let's suppose that unless the price is half of the actuarially fair price, so in other words, a pretty significant subsidy, suppose people in the vulnerable population just don't buy it or can't buy it because of whatever constraint. But if we see that when it is purchased, it slows down the number of people DFID has to give cash transfers to, then we are in a position to begin to start thinking about the extent of subsidy. So that's very much on our minds, because in this case, the individuals here are not tied in until now, actually. They will now be tied in more into a financial system. A project we have in Peru, people can effectively borrow the premium as part of a loan package to cultivate commercial crops. That doesn't exist here, so we didn't have that option to sort of effectively finance people's premium for them. Now, interestingly enough, you might have noticed in the video, they actually made a deal about, this is going to make people bankable, and they showed someone getting money out of Equity Bank in the little video. And that actually Equity Bank is extremely interested in this, as you can imagine. They've actually opened up a branch office in Marsabit town. And they're thinking, we in our meeting we had recently in Rome, we had the ag business person from Equity Bank there, and she's saying that they're trying to see how elastic they can be in terms of lending to people who have assets that are now insured, because typically no one was going to lend on somebody's cows walking around in that fairly desolate area, but if it's insured, maybe they will. So that gets to be sort of more interesting, right? I mean, so if an insured cow becomes a collateralizable cow, then things start to open up in lots of dimensions.
Ruth?
Yes, so in the pilot research we did, we priced the securities at the actuarially fair price. But we also, this was pure research. We didn't even know if this was a good product. So we gave cash endowments, which individuals could choose to keep as cash or to trade in for one of these state contingent securities. The next stage is to go to having these sold through an insurance company, and that's what we're planning on doing this season with Nyala Insurance Company in Ethiopia, and next season with we're doing some of the basic research work to do this for next season in India with HDFC Ergo there. And the way Nyala works is they take the actually fair price and they add their 20 to 30% markup until they have an idea that they keep the markup low in the first few years, and then once clients see the benefit, then they're much more likely to increase the markup. Yes, so we'll see how that proceeds. But one thing that I want to mention about securities is that this is not one insurance contract that an individual is buying at a certain point in time. It's sort of building blocks contracts. So people can choose to buy one week, buy another a few weeks later, and so on. And they're priced differently because they each have a different probability of paying out. And what was very interesting in the research that we did to see was that really matters. So even though all of these securities were priced at the actuarially fair price, the actual price of the security really mattered. So it starts you thinking, well, yeah, premium is really about the probability of the risk that you're insuring. So if you want to make some insurance available to some people really cheaply, then I guess it has to be very extreme insurance coverage. But that's essentially what we were seeing. There was that people were choosing to buy the tickets that were actually quite unlikely to pay out, but were cheaper.
Yes.
Miguel Robles from IFPRI. I want to bring one topic, which is the notion of upfront payment. Especially in the case of, Ruth knows what I'm going to talk about because we have been discussing about this. Especially in the case in agriculture. Look, in agriculture, conceptually you can define, let's say, there is the beginning of the year and the end of the year. And the shock, the potential bad shock, only can occur at the end of the year, or let me just say that. So given that, I always go wild with this because I don't understand why that we require upfront payment in this case, other than just for reasons for preventing default. Because look, the way insurance works is basically the insurance company, they take the premiums, that's the inflow of money, and they use that inflow of money to pay for the compensations. And some of that money is going to be for operational costs, but that's really not the big chunk of money is not gonna be for operational costs. So I really don't understand why that we are asking, especially in agriculture, why is that we are asking farmers to pay upfront? As I said, I mean, I understand one reason is because you want to prevent default. Because what would be the alternative? Just to ask the farmers to pay but at the end. So if you have a bad shock, then you don't pay. If you have a good shock, then you pay. But since the shock is already realized, then you're gonna have farmers saying, okay, I'm sorry, I already have the good shock, I'm not paying, and nothing is gonna happen. Now, if that's the reason, maybe we can find other mechanisms to enforce non-default. It seems to me that now the way we are enforcing non-default is not the first best. It's asking farmers to pay upfront exactly at the moment in which they are kind of tight in terms of cash, and they're thinking on investment, making investment in fertilizers or other inputs. So I guess this is more of a comment. I mean, I don't know if you have any words about this, especially and also I am a little bit puzzled. Like in the briefs, it seems to me that this was not a topic. Maybe I'm completely wrong, and there is no reason to go wild with this, in the sense that this is not a problem. But honestly, I see there is something, we're missing something, or probably we're not putting too much deep thinking on this.
Michael, Anna, Ruth.
Well, I mean, so you're just effectively what you're asking is whether I can use future income to pay for something I have to pay for ahead of time, right? So, there's the crop liens that you could have on a stand. It's basically saying, let me use my standing crop as collateral, and when I harvest it, I will have the money, and then I'll pay for a service I already got. And in principle, one could do that. Again, I think there are lots of places where that kind of finance doesn't work very well. But I actually gave an example of where that could work, right? So, and this is what the equity bank woman was saying, that insured cattle might actually function as collateral for them. So effectively, you're saying, well, if that's true, then the pastoralist who's very liquidity constrained at a certain point in time should be able to pledge an animal as collateral and have his insurance premium paid for him. And then once he's gotten through the year, if it's been a regular year, then he has to sell an animal and repay basically that loan. So, yeah, I mean, or if if it were a commercial crop, you could definitely do it, right? If it was an inedible that farmers produced.
Yeah. So I think it's exactly this kind of where, especially where it's built into this kind of value chain relationship type of thing, right? Where there's a third party. Because think about who's interested in that lien, particularly interested in that lien on a crop, right? It's not banks may, but actually the person who's interested in the corn, right? The processor or the trader, whoever. The problem is that the nature of those relationships and the degree to which side selling is a problem. Because I think the side selling, as I said, the side selling in Malawi is what undermined that, or one of the major things, according to David Rohrbach, the World Bank guy out in Malawi, said that he thought it was the side selling that really undermined the product, the groundnut insurance product in Malawi. I mean, there's a lot of work. I mean, Javi did, and others have done work on that insurance product, and said, well, people didn't understand the product, or maybe it wasn't designed right, or whatever. But they're now using, with the same population, insurance products in the tobacco value chain, and it's working fine, apparently. And there's plenty of uptake, and it's working fine. And according to David Rohrbach, again, it's because the value chain is much more disciplined, right? That the repayment works, and it's because they're advancing the premium, basically. It's built in with a loan, but it's tied into that value chain relationship.